Hi everyone, it's Alex here at Treasury Capital Research. Welcome to our weekly webinar. It's currently Thursday, the 8th of August, just after 4:15 Eastern for the benefit of the tape. We have a really special webinar today. It's been a pretty tricky week in markets. We had a pretty disastrous Monday open, a very volatile few days, and then a very strong up day today. And the whipsaw is confusing many and costing many money if you're unprepared and unready. And so given this level of volatility in the markets, we thought we would do a particular webinar to cover, first of all, just to look at equity markets and see how they're moving. Well, that's the easy bit. That's the bit I'm going to present. And then my colleague Yimin, who has written our macro work for some years and now is running his own service on our platform, is going to explain to us all what on earth is going on. And so we'll do this in two sessions. We'll do equity index review first. We'll pause for questions. And so if you're not a regular attendee at our webinars, and we throw the doors open on this one to any of our readers and subscribers, not just those in our top services. We run them all on an open mic basis, on the basis that the discussions we have in the webinars are the best part. We all learn something. The part I enjoy most is when someone inevitably says, this is probably a stupid question, and I can tell you it's never a stupid question. We have a rule in our chat services, which is there's no such thing as a dumb question, and there isn't. In investing and trading, in my experience, all the best questions are always prefaced by, this is probably a dumb question, but. So as we progress, if you have questions, points, comments, anything, please do ask. Either open your mic and shout, or alternatively, there is a question and a comment function in the webinar platform here. Please use that. We have chat rooms that many of you use. It's a little bit hard to keep track of all of them whilst running the webinar. So if possible, please use the question and the comment function in the webinar, or use webinar audio. So what we're going to do next is read our exciting disclaimer out on your screen right now, and then we're going to run through the equity indices. I'll switch mics on at that point, and then after we've done a few Q&A, we'll move on to the interesting bit, which is Yimin's part, and he'll walk you through what's going on beneath the surface here. Okay, so disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Treasury Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Treasury Capital Research. Treasury Capital Research values both its independence and transparency and does not believe this presents a material or potential conflict of interest or impacts the content of its research or publications. Okay, so let's get microphones on right now. Okay, so mics are on. So again, any questions, points, comments, anything, just open the mic and shout. Okay, so let's look at some charts. We're going to start off with a pretty boring set of charts, which are just some larger degree, longer run takes on the indices. And the reason to do this is, for me at least, whenever things are getting a bit crazy to the upside or to the downside, or every which way around, this is what's happening at the moment, I always find it helpful just to zoom out. This is a really simple chart of the S&P 500. We use here the SPY ETF, which is a good proxy for the index as any. And this chart starts from the COVID crisis low in March 2020, and it projects a wave one up that peaked right at the end of the bull market, December 21 to January 22, a wave two down that troughed at exactly the 0.5 retracement. In other words, the value that was created between March 2020 and the end of 2021, all of that was given up, half of that was given up between January 22 and October 22. So in 9 months, almost 2 years worth of value, half of 2 years worth of value was destroyed. As is usual, downward corrections lose value faster than upward movements create value. That's normal. We then enter this wave three, and We think, house view, that SPY can get to probably the 600 zip code, maybe higher, but certainly around 600, and let's call that around 6,000 on the S&P index for the sake of argument. And so what we think is the current sell-off is a correction, and it's a material correction, but it's not unlike what happened in Q3 last year. So Q3 last year, the S&P peaked in July at 458 on the SPY, and it dropped down to 409 by October. So from July to October, it was a 3-month sell down, and it felt, pretty rough at the time. And you had people, by the time October came along, questioning whether the bull market was all over and it was a fizzle and it was just a counter trend rally, and actually, it was just, we were still in the bear market, and. And so all of the concern you see right now, actually there was more of it last year because the sell-off went on for longer. The ferocity of the sell down, certainly Monday, took people by surprise. But so far, the degree of the sell down, not so bad. So you see here that we have so far, one red monthly candle. This is a monthly chart, and given that it's only August the 8th, that's a big correction for 1 month, 8 days in. But it's just one monthly candle, and so right now, house view is this is part of a probably seasonal Q3 correction. And okay, it started out a bit more brutal than they normally do, but this is probably just a Q3 correction. And so in our house view, the question is, how do you play it? And personally, my own approach has been to just wind risk in, because one doesn't know when the bottom is going to be in these things. And again, because markets sell off faster than they gain value, then you can lose a lot pretty quickly in a sell-off, and it takes a lot longer to gain it on the upside. So my own approach was just, I'd sold a lot of securities through July, moved to cash. I moved harder to cash on Monday and Tuesday. And then the securities I do have, I've hedged to the degree I can hedge them. And so my view has been basically make like a hedgehog, roll up, protect capital, and see what happens. And usually that will mean that you might miss the turn on the way up, but if that happens, you've always got plenty of time to catch up. Let's just have a look at the Nasdaq. This is the QQQ. Again, it's as good a proxy for the Nasdaq 100 index as any. And this really is where the trouble shows up in US equity indices for this correction. So again, let's start the chart at the same point. So this is the COVID lows. The Nasdaq puts in a move up on the QQQ from about 168 in March 2020 to around 405 for the bull market peak. It then drops to the 61.8 retrace to the dollar and tests that several times in October. This is 2022, October again, December, January, and finally takes off. And then the Nasdaq's been pretty much unstoppable since January 2023. This is the Q3 correction last year. We get a peak here at 387, and it sells down to about 343, so around, it's that 10%-ish correction. We get a correction here that peaked in March of this year at 446, and it troughed at 413. It's a bit less than a 10% correction. And then we get a very steep angle of ascent from the April 19th low up to the high, which was the week of July the 8th, and then a big correction down. This is a weekly chart. So this week so far is showing green on the week as measured from the Monday open. But as you can see, that's a pretty big correction. Let's look briefly at the Russell and the Dow, and then we're going to dive in and look at some shorter term stuff. So this is the Dow. We're using the DIA ETF, again, a good proxy. Now the Dow, as you can see, just visually, is really not as affected. So this is the COVID lows for the Dow. We get a bottom of about 182 on the DIA, moves up to 370, so more or less doubles by the time the bull market tops out. Very shallow retrace, a 38.2 retrace, more or less, whereas the S&P dropped 50%, and the Nasdaq dropped 62% in the same correction. The Dow actually was the first to recover from the bear market, and it ripped up and out of this trough in Q4 of 2022, flatlined a bit until Q3 23, and then took off. And it's been a very strong move up since October of 23. And you can see that the fourth quarter in 2023 was just fantastic for the Dow. You can see here that the correction hasn't been much in the Dow. So right now the peak was 413 in the DIA. We're now at 395. So, no big deal. Finally, let's look at the Russell. Russell, a bit weird of late, I would say. So from the COVID lows here at 95 on the IWM ETF, it puts in a huge multiple up to 244 for the bull market high. It then drops to around the 50% retracement, a bit lower, but it puts in this very strange behavior then. So it basically just trends sideways. And you've seen that none of the other indices do that. The Russell has the lowest quality issuers, the smallest companies. The narrative goes that they're most sensitive to interest rate changes, blah, blah, blah. I don't know about that, but I do know that they're just not such good quality companies as you'll find in the Dow or the Russell or the NASDAQ or the S&P. And so the Russell's been a great trading index for about 2.5 years now. Short at 200 on the IWM, long at 160, short at 200, long at 160, and so on. It's been a terrible place to invest because it's just gone nowhere. It doesn't have much of a dividend yield either. And the question all along has been, can it break out and over this 200 and turn 200 into support? And it tried a couple of times. Here's December 23, failed. Here's March 24, failed. Here's May 24, failed. And then this breakout happens here, which was tilted as rotation into small caps, which, I will say I missed personally because I didn't find it all that convincing. I couldn't see why you would dump securities in the S&P and buy them in the small caps. And this looks to me very much a sort of a fake out. So this was shot up a little bit and then has fallen back to initially below 200 and has recovered from that to close at around 207 today. So this 200 level on the IWM remains a key level. If IWM stays over 200, bullish, below, bearish. Now, let's zoom in a little bit and let's look at some shorter term stuff. So we're going to look at the QQQ here. And we're going to look at a daily chart. Let's just remove all drawings. Now, this is the short-term part I want you to look at. This is the April low in 2024. So I mentioned that we had a big sell-off in the NASDAQ, material sell-off between March and April, V-shaped recovery as this bottom happens here. And then this is the important part. Now, we noted in our Inner Circle service yesterday that it looked very much like the NASDAQ might have put in a low. Why we thought that was this here, which is the move up from the April 19 low to the 11th of July high, retraced and hit the 88.6 Fibonacci retracement level to the dollar, absolutely to the dollar, and then bounced hard off of that. And so I think there's a reasonable chance that whilst it might take some time to get back to all-time highs on the NASDAQ and the QQQ, that's 504. First of all, I do think they will be surpassed. I think we're still in a bull market, and I do think that NASDAQ will take out those highs. But I think that what we might see initially is something like this. So there's your, in this degree, 1, 2, and a wave 3, and I'll just leave those hanging up there. Basically, a move up is what I would expect over time from here. That doesn't mean in a straight line. So what we may see in the smaller degree is a typical stairs pattern. So let's go to the hourly chart. There's the wave 2 low. That's the 88.6 retrace I just mentioned. And best guess, something like this, which is this here is a 1 and a 2. I think we're doing this sort of pattern. So I think that we are starting to climb out of the lows that were put in around the close around the open on Monday. I do not think the volatility has got away. I don't think everything's okay because, as Yimin will talk about later, the Bank of Japan suddenly said, oh, well, we won't raise rates any longer. And I don't think the jobs news today is, fundamentally changes the story, although certainly eases the pain a bit. Let's look at the S&P 500. So we're going to use ES futures to do that. And this is an hourly chart. And again, this is from the April lows, like so. And we get a 1, 2, 3, 4, 5 waves up from the April the 19th low that peaks out at the 15th of July. And then we see what looks like a pretty clear A, B, C correction. That's down into Monday's open. And the drop into Monday's open is pretty dramatic, as you can see. And then it looks like from Monday's open, again, we've started to climb the stairs. And if you were to look at the delta from this point here, it's 51.21 on the ES E-minis, up to this high and down to this low, I'm pretty sure that's going to look like a typical 1-2 setup. Yeah, which it does. So there's your 1 up, 2 down, thinks about testing the 78.6. And the question immediately, I think, is now what? Because in both the S&P and the NASDAQ, today's close did not breach the intraday high yesterday. So we have this V-shaped bounce here, which came with things like the jobs news today. But we didn't get a decisive close. So I think there's every chance that we get a bit of a drunken stumble up and continued volatility, albeit in the general direction of up. And I do think, again, in the S&P, we will see new all-time highs, as my personal view. If we were to look at the Dow, again, zooming in, pretty much the same story. This is YM futures. There's the high on the 18th of July. And now we see the, again, characteristic A, B, C correction. And then if we zoom in, again, this is a 1 hour chart. You can see that it looks like that is a 1-2 setup. There's your wave 1 up, 88.6 retrace, holds, moves up. The problem is, again, the Dow did not break today in any convincing fashion the high that was put in intraday yesterday, or in fact, intraday on Tuesday, which is around the same area. And so this is a really tough spot short term, because we might well see a rollover to the downside in all these indices before another push up. And so again, my expectation is that I do think we will see new all-time highs in all these indices, but I don't think it's going to be straight up. I think there's going to be a little more whipsawing around yet, mostly because that isn't what people are expecting. So there's been a lot in the media and financial Twitter in the last couple of days where JP Morgan and others have been saying, oh, well, institutions bought the dip on Monday, and then retail piled in. And I find that a bit, I think that's a narrative. I'm not so sure it's true. So what most certainly happened on Monday is there was furious short covering, and that would have been by institutions who would have benefited from the drop in Asian hours through Sunday and the latter part of last week. As you will be aware, many retail brokerages were mysteriously closed on Monday morning, and so many retail investors were unable to participate. And so saying that, well, retail didn't buy the dip, well, anyone that tried probably couldn't. For those of you that use Interactive Brokers, which is the brokerage I use personally, who have no link to it and no benefit from it, that they had almost no problems, and so personally continue to find them to be a really high performance broker. And again, we have no relationship with them, we get no benefit for anyone joining up, nothing like that. But within our subscriber base, we constantly see people having problems with their brokers. I have to say I've never had any problem with Interactive Brokers. There was one or two wrinkles in their internal overnight liquidity pool on Sunday. That's a pretty, not many people use that. I had one or two problems there, but in regular market hours and even pre-market and post-market US trading hours, no problems at all. So institutions said, oh, well, institutions bought the dip and retail didn't. Again, retail in the main weren't able to. To my eye, that's a bit of a way to suck retail money in later in the week, and certainly that seems to have happened today. And so we'll see whether today's run-up is sustainable or whether that was exit liquidity for any short-term trading by institutions. So it's pretty easy to see what the answer to that question, which is if we just look at something simple like the QQQ ETF, and you could use the NDX index or NQ futures, any of this. It's very simple, which is, does this wave one high, which is the intraday high yesterday, Wednesday the 7th of August, is that breached? And does that turn into support? So let's call it 449 on the QQQ. If QQQ can get over that and hold that support, then probably we're in for a bullish move. If that's rejected, and it was tested a couple of times today and failed, it ran up right at the close and it ran slightly over after the close, but I don't think that's convincing. I think we need to see it move up and above 449, hold 449 as support, and if it does that, then I think it can move up. Otherwise, I think we're going to see another sell-off before an attempt up. And again, to my opinion, all of that is in the context of an ongoing bull market. So bottom line, I think the local low, I suspect, is behind us, but I think we're going to have some sustained volatility before we get a really committed run to what I think will be new all-time highs. Now, before we go on to the good bit, which is Yimin's part, let's take some questions and comments. So, Ron, you're on.
Thanks, Alex. Can you hear me okay?
I can, yeah. How you doing?
I'm great. Thanks to you, I moved an enormous amount of money into cash. It killed me to do it, especially on a day like today when I see everything I got going back up and in the green. But I think it was the best thing to do. Saved me a lot of money, so thank you. I have a two-part question.
Go ahead.
Okay. The first part is, do you believe that Japan is responsible for this collapse that we saw on Monday?
Well, Yimin will deal with that.
The Bank of Japan.
I understand.
Specifically, you know what I'm talking about.
I do. My answer is I don't know, because it's not my world. But I would observe the following. Okay. And I genuinely don't know. I'm trying to duck the question. I don't know. I'm not any kind of macro expert, and I don't know. What I would observe is this. Let's just zoom in and look at the Nasdaq on the hourly. Okay, there's a Nasdaq. So just try and take a snapshot of this. And then if we look at the Nikkei, so this is from Thursday, the 1st of August. There's the high, 1st of August, and there's the low, 5th of August. Look at the Nikkei. There's the 5th of August low, and you can see that, as we just said, I mean, what we said with the Nasdaq is that it put in this high early on Wednesday, sold off into yesterday's close, ran up today, and couldn't quite break the intraday high yesterday. Well, this is the Nikkei index, and it's got the same chart. It's the exact same chart as the Nasdaq. So this is Nikkei on the hourly. If we go to the Nasdaq on the hourly, then you have the same chart. And we can argue about fours and fives, but the same point, you can't break that intraday high. So I don't know whether Japan is really and truly the cause of it, because before Japan was tagged as the cause of all this. You'll remember that in a circle service in July, we were saying Q3 correction coming, right?
Yes,
Um,
yes,
uh,
that's true.
and that was on a seasonal basis. And so personally, the reason I'd started to sell securities and move to cash and hedge and all of that in July was because a seasonal correction was likely to happen just on averages. And so now the narrative is, oh, it's Japan's fault, which of course is a really easy thing, isn't it? Which is it's some other guy's fault. But probably there is some seasonal flows at foot. There's some de-risking ahead of the election, and along comes I suspect a convenient narrative that says, "Oh, I'll tell you what, we'll blame Japan." Now that would be garbage on my part, and Yimin's going to talk about that shortly. This is his world, not mine. So that's about as much as opinion as I have on that one, to be honest.
Okay. Well, uh, it, the idea of the question was basically if the raising of, you know, the rates by the Bank of Japan caused this crisis, then it was, and this collapse, then it was an artificial collapse. Had they not done that, things wouldn't be as bad as they are now. Um, and if all that is true, or even if it's only partly true, um, I agree with what you're saying that we were in a bull market. We most likely still are in a bull market. And I think the big question on everyone's mind who has been following you and who safely moved their money into cash, you think we will know, or we can know with any certainty as soon as possible when we can move our cash back into investments?
Yeah, I mean
Will it
that's.
be October or September, as early as sometime in August?
I, I mean, obviously, I don't know. I mean, I've I follow the charts. I don't much follow the news. I don't think there's any point, but I follow the charts. Um, to me, um, this pattern from April, short term, is really important because, again, just to back up a bit. So what we'd said, house view was, we said in July, probably going to be a Q3 correction, and seasonally, just on average, you see often that runs down into later in Q3, October bottom, something like that. What happened last year in 2023 was a peak in July, trough in October, not unusual. The severity of the correction this year has been much greater than last year. So I wonder whether we've seen the percentage drop that we needed to see, and whether maybe the low is in. And why I wonder that is very simply this chart, which is from the April 19th low. There's your sort of Q2 run up, if you like, and an 88.6 retrace of the Q2 run up. And a material drop. This is the QQQ from 503 down to 423. That's a sizable drop. I wonder whether we just had a very fast Q3 correction. Now, how I think we can all try and decide when is a good time to wind risk back on. I mean, first of all, most people, most investors, be they professional, retail, whomever, were not prepared for this, because they don't watch seasonality. People were not expecting a Q3 correction. And you can see that with all of the, coat posting everywhere. And so if you took care, if you de-risked and you protected yourself against this drop, then one is in a great position now. So if I look at my own accounts, and I didn't execute this perfectly, one never does, but I've got accounts that are sat, not very much below their all-time highs, and that's with accounts full of leveraged instruments. So they're all either cashed up or hedged, and one can always do it better, but it's gone okay, and I therefore have very sizable cash allocations ready to deploy. And of course, the next mistake that one can make is to not dial risk on fast enough. And so I think for me, at least, I turn to charts as to how to do that. And I'll show you what I mean, which is what happens next, today and into early next week is really important, because look, here's the low. Okay, here's this is the April low, July high, sell down into the August low. So this is Monday's pre-market open. And then it looks like, I'll just remove all drawings. It looks like what we might have here, as I said, is a 1-2 setup, which is a precursor to a wave 3. And if that's a 1-2 setup and we get a wave 3 next, then it might be that Monday was the low. Now, percentage-wise, percentage correction from the July high, it probably is enough of a correction. It's just that it's happened quickly. So anyone that follows seasonality, I think, will be saying, well, no, there's more to come. It's going to be weak until October. It's an election year. That's generally what happens, blah, blah, blah. And that may be. But the thing for me is that looks like a lot like a wave 1 up and a 2 down. And this looks a lot like the start of a wave 3. Now, even wave 3s don't go up in a straight line. So, let's say today was the beginning of a rip-roaring bull run. My experience is the same as yours, which is stuff's going up, and I made, I think, one short-term trade that went up. That's good, but I didn't deploy any capital at the start of the day, any meaningful capital. So if this is a wave 3 up, it'll do something like that, and it will retrace to something like that, and then it will go again. So for me, if this is a wave 3, then a time to buy is either, in general, for any security, if you use the Elliott wave method, is a risk-averse time to buy is when the wave 3 gets over the wave 1 high and turns it into support and then moves up again. So that the best risk reward is always, as you know, buy at the bottom of a wave 2. And for me, I looked at this come in, and I just didn't feel confident enough to buy this, because I don't think you can say with any certainty that this is done. But that move from Monday through Wednesday, a 61.8 retrace holding on Wednesday, that's a really important level to have held. That's an absolutely textbook classic wave 2 low in a bull structure. And then today's pretty sharp move up, that looks and felt like a wave 3. And so if, on the NASDAQ, if that turned into 449 support and moved up, I'd feel pretty good that the next move was up. And I think that it might be that was the low back on Monday. If, however, this fails, and what happens is we don't really get a third wave, I'll change the numbers in a minute, but it just retests this wave 1 high and fails. So if tomorrow we see a material sell-off, then this wasn't a 3 up. This is just sort of meandering. And meandering, it's okay to trade long and short in little bits every now and then, but that's not an investment sort of strategy. So if what we get is, sort of sideways action for a bit, sort of in this box, or maybe it runs up a bit, but you don't get a real breakout, then I personally won't be winding capital back in at that point. What I'm looking for is, show me evidence that there is a breakout, that there is a clear technical pattern that proves that was the low. And if that fails, then some other low will be put in, and that might be the start point. So for me, I have a exciting life, and I watch this stuff all day, and I'm always looking for moves from lows to highs and retraces back again to see, well, is that likely to be a low? Are we likely to get a sustained move up? Did the move up fail? I look at this stuff all the time, and as you know from the Inner Circle service, I look at this on a monthly time frame, a 5-minute time frame, and everything in between, because as you know, if you can see things on a shorter time frame, they probably expand out to a longer time frame. So my view is, when can we declare that the worst is over? Maybe now, but not definitely now. So as a very simple thing, if the QQQ turns 449 into support and moves up and really turns into support, tests it and keeps moving up, then I think that Monday spike low might have been the low. That would be my very simple test. because the QQQ's borne the brunt of this. The thing that's been hit hardest has been the NASDAQ index and the Philadelphia Semiconductor Index. And so if those two start to move up, then the S&P and the Dow and maybe the Russell, but certainly the S&P and the Dow will probably follow. So that's a long answer to your question.
Well, that was a long answer, maybe, but it was the best possible answer you could have given. Thank you, Alex.
Welcome. I'm not going to take further questions this time. I'm going to go to Yimin because he's got a great presentation to make, and I did not want to run over his time. So we can come back to stuff at the end if we like, but I'm going to make Yimin the presenter here. Yimin, how are you doing?
I'm well, thank you. Thank you for inviting me today. It's always a pleasure to present to the Inner Circle members here.
Not just Inner Circle members, but
and
people who read all of our stuff, be it paid or free.
Nice. Wide
invite today. Okay, so you are now the presenter.
Okay. Can see my recording all right?
Yes.
All right.
For those who don't know you, do you mind just giving it a little bit about your background and how you got here and so on?
Of course, yeah. So I am, so by training, I was a chartered accountant as well as a trader. And primarily, I used to trade FX swaps and interest rates derivatives at Royal Bank of Scotland before starting my own business. And I have written for Seasonality Capital for over 4 years now, I think. More than 100 pieces of writing on the macro stuff every month. So I've decided to start my own service with Alex here. I'm very excited. Everything I present today is actually I showed it to my members as well, so they get an advanced view of what I present today. And it's quite easy to just, when you have a question, it's actually quite easy for me to just screen grab of what I have already. If you haven't already, we have a 7-day trial that you can absolutely risk-free and access everything we have already through the launch pass, which Alex will share after this video. All right. So while Alex was answering the question, I actually just grabbed the seasonality charts from my own service, and I compiled those myself for SPY, IWM, and QQQ. So seasonality-wise, Q3 is a very tough quarter. You can see for most August and September's, the red bars, and things do start to turn better in October in the run-up towards the election and New Year. So I think that does help answer the last question a little bit more. But apart from seasonality, which explains part of last week's move, I also want to present this chart. So this chart, as complicated as it looks, it is the yield spread of the 10-year treasuries between US and Japan versus the QQQ, as well as dollar yen, the FX currency. What it shows is that at the beginning of July, the yield spread was 3.4%. It dropped down rapidly to 2.84% after the non-farm payrolls on Friday, which is at the bottom here. And you can actually see that dollar yen also follows suit and QQQ also dropped. Why is that? So there is something called the global carry trade. To put it simply, is to borrow in a low-cost currency like yen, which only charged 0.1% interest rate, and put it onto risk assets abroad. It doesn't have to be US, but it's generally US treasuries or US equities like the Magnificent Sevens, which is why QQQ was so bitter this year. But the yen carry trade has been unwinding. But it wasn't just this week that was unwinding. You can see throughout July, it's been unwinding because the dollar yield has come down domestically to pricing the Fed cuts after the soft CPR report, and there was over seasonality correction, and dollar yen has got cheaper, which means yen got stronger. So those carry traders who borrowed yen, swapping to dollars, were also losing money on the FX trade if it didn't hedge. So all of a sudden, they're getting really squeezed, and that accumulated to a climax over Friday and Monday morning in the Asia session, where the Asian traders have to digest Friday's report and de-risk and leverage. then we have the bounce this on Tuesday and Wednesday and today. But the good thing is, the Bank of Japan has said they won't raise interest rates when financial markets are unstable. Essentially, they've been held hostage by the financial market tantrum. And also this morning, JP Morgan, the quant desk says 3/4 of the carry trades are unwound. So we are closer to the end of this carry trade unwinding than the beginning. But the remaining issue is that domestically, the Fed has not committed to a cut in September at all. We all know the Fed will do it, but they have not given the forward guidance. And so I want to take the chance. So we've explained the Japanese part. That part is largely done, but I actually want to take the chance to talk about the Fed and how the Fed approaches interest rate and how we can take advantage of the changing dynamics in the market. And towards the end, I'll show you our Treasury ETF analysis and potential trade ideas around that. So what exactly is the Fed's job? So contrary to popular opinion, the Fed is not responsible for GDP growth. The Fed is not responsible for avoiding recessions. The Fed is not responsible for 10% stock market CAGR, which is quite hard to believe after what happened after COVID. And the Fed theoretically should be unbiased towards either of the presidential candidates, even though Trump had openly said before that he would fire Powell if he got into the White House again. The Fed's two main mandates are maximum employment and price stability. Simply, maximum employment is if you wanted a job, you can get one in this economy. Price stability is a bit better defined, more precisely defined to be 2% PCE target. So the question is it possible to have maximum employment and stable price, low price stability at the same time? A lot of people would argue that if you hike interest rates, people are going to lose jobs, inflation will come down, so it's more like a push and pull. But actually, historically speaking, there isn't that much correlation between inflation and job reports. So the Fed knew this. In the past 3 years, the non-farm payrolls had been very strong, even as inflation came down. So that's why they felt so comfortable about their approach to interest rate policy at the moment. And they were right up until maybe beginning of this year. We had maximum employment in 2023. 3.4% unemployment is something that you could only find back in the 1960s. So that is very strong labor market. And that's partially because, so that's basically down to the supply-demand imbalance, where there was a lot more demand for labor, but not enough supply after COVID, essentially. But actually, this year, things are not looking so good. So if you look at the right-hand side of the graph, we had some strong non-farm payroll reports in Q1, but slowly those reports are getting revised down first. So they report some high figures, and next month it gets revised down. But also unemployment rate is creeping up. So last Wednesday, we had an FOMC meeting, and at that time, they didn't have non-farm payrolls report. So at that time, the unemployment rate was 4.1%. Powell would argue that the labor market is still in a process of normalization, and 4.1% is very acceptable. It's still historically low. But the 4.3% is actually very high now after the Friday's report compared to what we had last year. It's the speed of this, it's the gradient of the slope and how fast things are evolving that the market is feeling very uncomfortable. And this could be a recessionary signal, and I'll explain why. If you think about GDP is essentially the number of hours worked in the economy times their earnings, so the total productivity. Strong job reports correlate strongly with economic growth. So I've run this test for the past 10 years. the correlation is 0.61. They're not always going to be the same, especially during COVID, but they're very correlated. So weakening labor market signals that there is lack of appetite for hiring, and there is potentially lower wage growth as well. People earning can't really easily find higher paying jobs. And this is also showing the data. We have cooling wage growth from 5.5% year on year 2 years ago to 3.6%. You could argue that 3.6% is still pretty good. If inflation is at something like 2.5% and you're earning way above inflation, that's still real earnings growth. But it's coming down rapidly, and the implication of wage growth decelerating is actually also cooling inflation. So again, past 10 years chart, very closely correlated hourly earnings versus core CPI. Core CPI is inflation without goods and services in the urban area. So that makes sense, because if people are making less money, well, they're not necessarily making less money, they're just earning at a slower growth rate. If there's the cost of labor is slowing down, then businesses don't have to pass on the price as much onto their goods and services. So this is how everything is linked together, and then inflation comes down. And there are things that the Fed can control, and there are things the Fed cannot control. So, historically speaking, again, the Fed policy commands a 7 to 8 month lag between when they raise rates and inflation coming down, and it's pretty consistent against both CPI and PCE. The difference is that CPI is urban inflation, PCE accounts for suburban areas as well. But the Fed cannot control everything. Oil is a big part of it, right? So if you look at historical headline inflation versus oil price, it's a pretty strong correlation. High oil prices means high inflation, high energy prices. And not only does it have an impact on actual inflation, it also has an impact on the forward expectation. So the five-year forward break-even is the market gauge of what the inflation expectation is in 5 years' time. So again, it correlates very strongly with oil. Apart from oil, there's also supply chain issues. So during COVID, shipments cannot get out of Asia to Europe and US. And during Ukraine war, we are seeing a lot of supply chain constraints coming out of that area as well. So these are the supply side factors the Fed cannot control. Control. So now the question is, has the Fed cut too late? Everything was looking quite rosy at the beginning of last year, even towards December, as inflation came down. And I still remember in the December FOMC, Powell was very optimistic that they're nearly there in terms of moving towards the target. But actually, if you look at the 12-month trend, the headline inflation was getting sticky, and the core CPI was also slowing down towards the year end. It wasn't that bad. But what really spooked Fed was that in Q1, there was sudden resurgence of inflation readings. And they just weren't sure whether it was seasonality factors, because the restaurants, for example, and shops are resetting their price for the new year and just do a big 10% increase, for example, instead of doing little by bit throughout the year. Or actually inflation is coming down. And secondly, the Fed was really unhappy that the bulk of disinflation for 2023 came from goods, and rather than housing and non-housing services. And this chart makes it really obvious. So if we take 3-month annualized rate, which is just look at the past 3 months, extrapolate for a year, we can see inflation was, especially service inflation, was spiking up again towards end of Q1. And this really had the Fed worried. The impact of that, we are still feeling today, actually, even 5-6 months on. This is because now we had 3 months of hot data. How much good data, as in lower inflation data, does it take for the Fed to have confidence that the interest rates and the monetary policy is working and the inflation is getting back towards target? And the Fed is deeply divided about this. So much so that they moved from a median projection of 3 cuts in March to just 1 cut in June. And as you can see from those dots here in June's dot plot, about the majority of the FOMC members want 1 or fewer cuts for 2024. And it's a big minority want 2 cuts. And if you listen to their speech, the 2 cuts camp say everything is actually moving towards the target. We just need a bit more evidence. We can start cutting in Q3, maybe Q4. Whereas the majority of Fed speakers were saying Q4 earliest, maybe even Q1 next year. So on Wednesday, Powell was not in a position, or the Fed was not in a position to get into consensus for which should have been a live meeting in July, but wasn't. What they emphasized on is that we need more data to be confident. They're data dependent and not data point dependent. And this could be a very crucial point now, because Goolsbee, one of the Fed non-voting Fed members, on Monday or Tuesday said that a single job report doesn't change everything for us because they're not data point dependent. Okay, so sorry, if I can just refresh this, make sure we're getting the right pictures. Sorry about that. All right. So while between Friday or even Thursday, actually, after a bad PMI data, between Thursday and Monday, it felt like, hell's coming loose. Actually, the bond market was already calling the Fed's bluff ahead of the non-farm payrolls report, especially after the CPI report that was released in mid-July. While the Fed projected a median cut of just 1 cut for 2024, the bond market was already pricing in 2 cuts with a chance of a November cut as well, ahead of the non-farm payrolls. And Thursday and Friday, the bad job report just really pushed the market towards recessionary concerns and lowering the yields. And at one point, I think on Monday, we even priced in 125. So this is saying 140 basis point of cuts for 2024. What that means is potentially a 50-50-50 back-to-back September, November, December cuts this year, or even maybe 75 basis point in the first meeting, then 50 and 25. So, but these bets have now rewound, and we are now looking at 50 basis point cut in September, projected by the market, and then followed by 25 and 25 basis point in November and December. And at the same time, I just want to pull out the 2-year, 10-year yield spread. So in a normal, like in a booming economy, the yield curve should be the yield curve the yields in the 10-year should be higher than the 2-year, and that's called a normal yield curve. When the 10-year yield drops below 2-year yield, that is inverted yield curve. So that's not normal, that's inverted. And I think nearly always it precedes a recession. And the recession usually happens when this inverted yield spread tries to revert above zero and into a normal yield curve. The New York Fed uses the 3-month 10-year bond rate as a model. So it's the same idea. The 2-year, 10-year yield spread is more advanced because the 2-year yield already incorporates the rate cut expectations. But it's the same idea. If you look at the past history, every time this yield curve drops below zero, gets inverted, and then when it tries to normalize again, we are already in a recession. And currently the odds of recession is over 50%. It's been this way for some time now, maybe a year. On Wednesday, Powell essentially just dismissed it completely, saying, I don't see it coming. Conventional wisdom doesn't work this time. Hence, the quote history doesn't repeat, it rhymes. At the same time, Friday strawberry report also breached Psalm's rule. A quick explanation what Psalm's rule is. If the average unemployment rate over the past 3 months is 0.5% above the 12-month low of the previous 12-month low, then the economy is already in a recession. And it's designed by a ex-Fed economist called Claudia Sam. You can follow her on Twitter. Every single time, this rule is called, apart from this, like in the late 1970s, I think over here, we are always in a recession. So there's a lot of evidence that recession is about to happen, and the Fed is just ignoring those signals, saying this time is different. So that the combination of the Fed refusing to acknowledge recessionary concerns, refusing to commit to cuts in September, let alone 50 basis point or inter-meeting interventions, is what gets the market really volatile and worried. Market does not like certainty. If Powell says, I think even if Powell steps up now and say, we're still assessing, we are not committed to, even if he just speaks, I think it will calm the market a little bit better. But he hasn't done that yet, and he probably won't do that until Jackson Hole towards the end of the month. And that's a long way to go. And the September meeting is still 6 months away. So there's a lot of uncertainty and volatility in the next 6 weeks. And what makes it worse is that August is holiday season. Liquidity is very thin. Traders go on holidays, and so one small movement can get very exaggerated around. First in London, then in New York hours, and the next day in Asia. So the regime we're in now is risk on, risk off. What that means is that sometimes yields behave in the opposite way of stock market. So lower yields, 10-year bond rate, tend to help the stock market, and this is because future discounted cash flows are reevaluated at a smaller discount rate, which yields a higher NPV. That's the theory anyway. And you can see that it happens over here. So low bond yield, high QQQ. Sorry, high bond yield and low QQQ, and low bond yield, high QQQ over here. QQQ is the orange line here. But at some point, it's from mid-July after the CPI report, they are moving in sync now, right? Largely in the same direction. Lower yields, lower QQQ, stock market. And now when the stock market is rebounding, yields are up. I think yields are up as well. So we're now in the risk on, risk off modes, and equities are closely following the changes in the bond yields. So the bond yields actually can give us an early indicator of where equities can move next. And I've shared this chart with my channel as well for the past week. We've been calling this every step of the way. So how far can the yields go, right? And inversely, how high can you take advantage of this in the Treasury ETFs? So I've selected the 20-year, the TLT, the popular Treasury bond ETF, and correspondingly is a 30-year bond yield. And the math works that every interest rate, every percentage move in the bond yield translates to about 16.7 percentage point in the opposite direction in the ETF, and that's because of duration. We saw the bond yield essentially construct a near-term bottom at the beginning of the week after that volatile move. Now I think what we are now is a wave for bounce in the yield and wave for pullback in the ETF, and I think now we're actually going to potentially revert and progress towards that wave 5. That wave 5 in the 30-year yield means a 40 basis point drop, which is quite a lot actually. And I'm just thinking about the catalyst. We have a CPI report, a very crucial CPI report next Wednesday. So between now and then, the market can get a bit. So what's going to push this up and what's going to push the yield down is a soft CPI report. If CPI, especially core CPI, comes below expectation, then it's really showing that Fed is acting too late and they need to play catch up and rates need to go lower. So I still think yields can go lower from here. And correspondingly, that could mean stock market also go down with it because of the risk of mode. But with everything, the chart can change. We can see this spike up and invalidate my chart as up, and we have to take everything step by step. So so it's definitely worth watching. So I just want, if we still have time, I just want to talk about what this trade means if you are long the 20-year TLT, 20-year Treasury bond ETF. So this is the bond yield curve that you see in the media or on TradingView. So 1 year, 2 years. So the rates go down towards the 5 year and it goes back up again after 5 year bond rate towards the 30 year. I don't like this chart because it's talking about spot yield. If I borrow money for 5 year from today, it's 3.8%. If I borrow money for 10 years today, is or rather the US government is 3.99%. It doesn't really tell me what the market expectation, where the market precisely expects the Fed to cut and the Fed to hike. If you translate those into forward yields, just meaning that what is the bond yield if I borrow for 1 year starting this time next year? It's actually 3.6%. What about 1 year starting from 2 years? 2 years from in the future, 3.5%. How about borrowing money 2 years for 2 years, 3 years in the future, 3.7%. So you can see that actually most of the cuts are expected within the next 2 years, essentially the next year. The curve over here is quite flat and it normalizes. We have a steepening curve, a forward curve from the 2 year onwards. So the market expects, what essentially the market is saying is that if the Fed cuts rates rapidly, appropriately, and we can probably avoid this recession, and we can think about stable, a high neutral rate around here, and hiking rates again, having a normal yield curve, having the normal term premium, et cetera, into the future. That's what the market is predicting. It becomes more obvious. This is the SOFR 3-month future. If you borrow money for 3 months, collateralized using treasuries, then this is the yield curve you get as well. So it's the same shape. And in the front end, we're pricing in, apart from the first few cuts, what I mentioned earlier, 50, 50, 25, 25, 25, all the way till May, and then 2 more cuts in second half of the year, and then a terminal rate at 3%. That's what the Fed Fund futures are predicting at the moment. But I don't like this. I actually think all of this is too high, and I'll explain why. If you think about the chart I showed earlier, CPI and oil prices, low oil prices mean lower headline inflation. It's not clear to me that oil prices will score strong spike from here. And actually, since 2014, we have had a very low oil price regime where the oil prices are below $80 per barrel. When the oil prices are below $80 per barrel, you have over 2/3 chance of inflation staying within target. If it goes above, then it's very likely we'll have high inflation. But the recent history says that OPEC is desperately trying to put a floor in this region and still not going up. And if we have a recession coming, these oil prices might go back down towards the 2016, 2019, 20 area. And inflation may not be that high, and actually it could undershoot the Fed target. A low inflation means the terminal rate should be lower because adjusting for inflation, you don't need a high neutral rate to give you a real yield. Again, you can see that in the rates market as well. So this is using the 5-year break-even rate in the financial markets. Currently, the 5-year inflation expected by the market is 1.9%. This is lower than the Fed's own target. So the market's saying inflation will go down below or undershoot, right? If the inflation undershoots and if we have a recession, the neutral rate shouldn't be 3%. It should be more like below 2% or even lower, right? So I think in the longer term context, all of that could go down. Or this entire curve could shift down. But it's not going to shift down tomorrow. It's not going to be done in a week. It will evolve over the next 24 months. It will become clearer whether we have a recession or not, whether oil prices will stay dead, and whether all the other factors will come into play. I just want to zoom out, right? Alex is very saying like just zoom out and look at the charts. This is 3 decades of data. Is it 3 decades? Nearly 4 decades of data, but 3 decades up to 2020. The bond yields just is a one-way street. We have the longest bull market in bonds, meaning bond prices up, yields lower, for the past 3 decades until COVID. To me, that the resurging inflation after COVID, that feels more like potential transitory than the other way around. So unless can always be wrong, the chart can always invalidate this long-term trend, but this is 30 years, 3 decades of data showing that inflation is coming down, and fundamentally, technology makes everything cheaper, high productivity. We had cloud, digital transformation, now AI. Inherently, inflation doesn't always. There's always a downward pressure on inflation. Have I run out of time? Oh, have you got?
You ran out of time a while ago, but I'm fascinated, so I thought we could keep
Okay,
going.
cool.
I have a question for
Okay.
you, Yimin, if that's okay.
Yeah,
It might
yeah.
be an unfair
of
question,
course, yeah.
and it's probably a stupid question, which is this. So that chart there, which shows declining bond yields, a function of declining inflation, it sort of troughs out at almost zero, where
Yeah.
bond yields were close to zero, inflation was close to zero, and that came at the end of, as you say, technology for sure, reducing costs, but also, the globalization move where you push production to the lowest cost location, you distribute labor to the lowest cost location, which was politically in vogue for most of that chart, and then since around, let's call it 2014, 15, 16, has been a little bit in reverse. And we'll see where that ends up politically. But now you have increasing rigidities in labour markets, increasing tariff and non-tariff barriers, and so the globalizing impetus has been reversed a bit. Now, so my question is this: if that run up in yields and inflation is a sort of a COVID and a Ukraine war artifact, and as those effects ease, it starts falling again. Does that mean the bond yields and inflation go below zero? Does that take us to a deflationary environment? Is that plausible? Is that something that could happen?
So we can refer to essentially Europe and Japan for that model, and I think Europe has been hovering around below zero. Like you have to pay money to the bank to put your money there.
Yeah.
And Japan, I think for 2 decades now, like below zero or zero interest rate.
Yeah.
So it is possible. It is theoretically there is a zero floor. But if you account for even 1% inflation, that means negative real interest rate.
Right.
If you get close to so yeah, I think it can, and I think it will hover around zero because there's a theoretical floor, but you will have a Eurozone and Japan situation.
Yeah.
Essentially,
Where I was going with this is when I'm no kind of macro person, but I see a lot of sensible people saying there might be a US recession. And I don't mean, perma bear idiots, all of that. I mean sensible people. And the phrase that I keep seeing from sensible people is, a deflationary bust, basically. So prices going down at such a rate that they offset any unit growth to mean that GDP goes backwards. And so this
Okay,
chart
yeah.
catches my eye, which is, if inflation is very, very low, if bond yields are very, very low, does that mean, deflation? And does that mean that that's the nature of any recession? That's sort of what I was wondering.
Yeah, so I think inflation. So what really is important is the inflation expectation, and it's partly why the inflation is set at 2%.
Right.
Is because the inflation expectation can be a self-fulfilling prophecy. What that means is that if the businesses expect inflation to be stable around 2%, they
Yeah.
can clockwork hike their prices 2% every
Yeah.
year to just
Yeah.
match the nominal
Yeah.
growth.
Yeah.
But if they expect, well, it's basically this actually did happen to Japan. If you expect deflation, your money is worth more later. And
Right.
actually, if you think about something like Bitcoin, where people think it's a deflationary asset, then you are not inclined to spend it today, and you want to hold your money, and we
Right.
can spiral down into deflationary area, right? And hopefully, it's not like two pizzas today is worth £1 million tomorrow, but but you get the gist.
I do.
Yeah. It can be a self-fulfilling prophecy. So I think actually just touching on this with the upcoming election cycle could be very interesting because yes, Trump has tariffs going, but he also said he wants to produce more oil locally in the US.
Yeah.
And if oil prices go down, it may offset the effects of tariffs.
Yeah.
Whereas if the Democrats get in, they might be more open to immigration, which actually supports the labor market,
Yeah.
and that would drive the wage growth lower as well.
Oh, yeah.
So there are, it's actually not quite as black and white. It actually it comes down to the implementation of those policies and how they offset each other. Yeah.
That's great. Thank you. Okay, I'll shut up. I'm sure folks have questions for you, Yimin. We are a bit over time, but if anyone has questions, comments, anything at all, now's a really great time. Just FY, we'll post this recording on YouTube afterwards for everyone to watch, and anything you don't get a chance to ask now, you can always post as comments on YouTube. But if anyone has anything burning, now's a great time to fire them at Yimin in person. I absolutely guarantee there is no such thing as a stupid question. What I often find when people give very brainy presentations is people don't ask questions because that they don't think it's their area or whatnot. I can assure you that I know everyone has a ton of questions and no one wants to ask them for fear of feeling dumb. It's not possible to look dumb with these things because no one knows the answer. So why Yimin's work is really good is he's lived this professionally. He's been a professional rates trader where you have to be on your game. That doesn't mean his every idea and answer is correct, and it doesn't mean he's all over every topic. He isn't. But what he is very skilled and educated in this area. And so if you have questions, comments, even if you don't ask them right now, do fire them in chat later. Tim, I think you're on.
Yeah, thanks, Yimin. Nice explanation. Just a question: as you see this progressing, it sounds like it's a bullish thing for TLT and your TMFs continuing to grow as this stabilizes. Is that a correct statement, or am I reading too much into that?
Yes, so I think in the short term, we have so if we look at the technical analysis, we have a final leg up, and I think that could be between now and the Jackson Hole and for the September FMC, and we might have a pullback in that because the market is quite volatile right now. So it won't go straight up, but I think in the longer term, I'm bullish on rates, essentially bullish on the ETF, bond prices, etc. Because I think, if any of those things happen, recession, or low oil prices, or all these exogenous shocks, and low inflation undershooting the Fed's target, and it seems like it could be given the recent trend. I think the yield curve is still too high as a whole. I can see it dropping towards 2% terminal rate, for example. I think Powell said last week that it feels more like 2019 now. 2019, we had a terminal rate of 2.5% Fed funds rate, and essentially Powell had to cut it after that. I think that was actually, he may have cut it before 2019, but as we had the trade war, he had to cut it before. He had to do a couple of cuts before COVID hit anyway. So I can't really see this terminal rate to be stable around 3% here. Yeah.
Thanks, Yimin. Anyone else, folks, before we wrap up? Okay. Well, as I say, we'll post this on YouTube in a couple of hours once it's upscaled. I'll post the link in all of our publications. So howsoever you arrived at this webinar, you'll see the recording. Do watch the recording, and also you can post questions on there. If you have access to any of our chat rooms, Yimin's in all of them, so you can reach out there. Hopefully that was useful for you. And if you'd like more of our webinar content, we do produce them free sometimes, but we run them twice a week in our various premium services. Yimin's also producing one a week in his pay service, and his service, YX Insights, is just getting started. You can take a 7-day free trial to the service, and you can join at low launch prices right now. So if you're interested, it's a really great time to start. I'll post a link under the video and in our various publications and chat rooms where you can sign up for that service. Thanks everyone for sharing it today. We had a great attendance today. Yimin, thank you. Fantastic presentation as always.
Thank you, Alex.
Yeah, and look forward to seeing everyone soon. Thanks a lot.